guys, welcome back to the channel. So today I'm here in the suburb of Strathfield, where it recently had an auction clearance rate of 100%, along with 10 other suburbs here in Sydney, which also had this perfect auction clearance rate. And that just then was an auction for a house that just sold off for $4.5 million, which unfortunately is just the norm nowadays. And no one really even bats an eyelid when that sort of prices sell. But I did notice that there's slightly less auction bidders nowadays than there were about a month or two ago. So things might be changing, and that kind of just shows you the pace at which the Australian property market is growing at. So today I wanted to see what you can do in this type of property market. But first, it's been pretty windy, so I hope you can hear me. So let's just go inside first. Yeah.
Now, at the moment, auction rates are hovering around 75 to 85% in the capital cities, especially in Sydney and Melbourne, and that's due to two factors. First, the overwhelming number of buyers who are out in force because of things like low interest rates, relaxed lending laws, and just not being able to take a big holiday because of, the pandemic and all. The second factor is the low housing supply, which really intensifies the fear of missing out. And the combination of these two factors create this effect to artificially pump up the median house price in advance of its natural price growth. And not to alarm you right now, but in Sydney, the median house price is now $1.3 million. Now, you might be thinking, I'll just wait it out, I'll keep saving, and then when I have enough, I'll go and buy something. Well, the reality with that right now is that house prices are growing faster than what people are able to save the deposit at. And this forces people to try and overextend beyond their limits so that they can buy the house now so they can enjoy the capital gains while this boom is still on. But because of this type of thinking, the total house loan value is going up faster than the number of borrowers there are for those loans. And that just means that every house owner is borrowing more to be able to join this exclusive club. And I fear that that's not going to end well for a lot of homeowners who overextended themselves, because at some point the housing regulators are going to come in and they're going to restrict lending at some point. And when that happens, I think the price will start to stall and possibly even dip even a little bit at that stage. So let's discuss how you can still get on the property market today in this housing boom without trying to overextend yourself too much and then ending up with a mortgage that you're going to be paying off for the next, 50 years or so. Firstly, and this one's going to be for the first home buyer, is to contribute as much as you can to your superannuation. Now, if you're not aware, there's currently a government scheme that lets you use your super up to about $30,000 that you can use as part of your deposit for your home. And next year, that's going up to $50,000. And the reason why you want to do that is because super is actually taxed at a lower rate of 15%, which means that you only need to earn about $35,000 to be able to get that 30 grand in hand. Versus if you do it the normal way, so say through your wages, you'll probably need to earn around $45,000 or so pre-tax to earn that same $30,000 for the deposit. Now, the rules will vary slightly depending on how much you earn. So for example, if you earn less than $37,000 a year, then that contribution to your super is actually completely tax-free. Or if you're earning more than $250,000 a year, then that 15% tax rate actually doubles to 30%, which kind of removes all the advantage of depositing into your super in the first place. But let's face it, if you're earning $250,000 a year, you shouldn't have any trouble buying a house in Australia. Now, the second strategy is actually to buy one suburb or one train station away from where you are previously priced out. Because quite often, there's a saving of more than hundreds of thousands of dollars for just one suburb or one train station across for pretty much the same type of house. And if you're happy to just drive that 5 minutes further from where you'd wanted to live in the first place, you'll be able to buy your first home sooner and many years before that as well. Let me give you an example. In Sydney, there's this really affluent suburb in the northern beaches called Pymble, and just one suburb away, or one train station away, is another suburb called Turramurra. If we look at the sold results for Pymble, there's houses that sold for $3.8 million, and another one for $3.1 million, $3.8 million again, and $3.7 million. So between $3 and $4 million seems to be the average. If we do another search for Turramurra this time, 2.5 million, 2.1 million, a 3.3 million here, and a $1.7 million home. So you can see it's a much more affordable area if you're happy with just traveling one station further. And there's places like this all over the capital city, so take your time to research these places, these little small pockets where prices are lagging behind its rich neighbors, and you'll be getting on the property market years sooner. Now, the next thing that I wanted to bring up is that we all know houses are really expensive and unaffordable right now on one hand. And on the other hand, apartments are pretty oversupplied at the moment and getting a pretty bad rap because of towers like Opal Towers and Mascot Towers, which are starting to show defects in the foundation of the walls and the base of the concrete and things like that, which doesn't bode well for people spending hundreds of thousands of dollars trying to buy their forever home. So something that you should definitely consider are duplexes and townhouses. They are the happy ground between the two and offer the best of both worlds while still being quite affordable in their own right. They've got much lower strata and maintenance costs and are actually closer in sizes to houses than apartments, which can be really suitable for small families. The reason they are more affordable than houses is obviously because they are on smaller blocks of land, but if you're not big into gardening, or if you're not at home a lot and have enough time to do a lot of landscaping, I think townhouses and duplexes are the perfect fit. And you'll be saving hundreds of thousands of dollars at the same time, which is always a bonus. Just take care when you buy them, because the best way to get capital gains on them is to buy in an area where houses are still in low supply or houses are still in high demand as well, because over time that will compound out to larger capital gains for you too. And now the final strategy that I think you can use is to buy with a plan to rent it out. So essentially become a property investor. Now hear me out. Investing in property is something that I highly recommend because it means that you can use the potential rent money in advance to help you on your loan application, so you can show the bank that you will have a higher income after you purchase the property, and can really help with your loan approval process. You can do this by asking for a loan appraisal from the agents that are selling the houses, and then you can use that to include as part of your bank loan application. Now, in the meantime, rent yourself a location that you want to live in. Now, this is what's called rentvesting, and it brings out a whole heap of tax benefits that you can use, such as depreciation and negative gearing, that will really help you to minimize your taxes as well. And by doing that, that will help you to pay off your mortgage sooner, which means that you can then move in yourself earlier as well. Investing in property is a great passive income which lets you leverage your money and lets you earn returns on money that isn't yours yet. And also, the interest that you pay for your investment is also tax deductible, which means that all the tax that you paid on it, you can claim back at tax time. But just like every form of investments, there's always risks to it as well. So for example, as a property investor, you might not be able to rent it out on time, which means that you need to bear the full cost of holding this property. Or you might find some bad tenants which damage your property, in which then you have to spend more on repairs and maintenance. But generally, you should have an easier time buying property as an investor than as a first home buyer. So sure, you'll give up all the government schemes to help first home buyers, but as an investor, it means that you have an easier time finding the funds that you need. Now, of course, all of these are just suggestions. You need to find your own way to jump on the property market without giving in to that FOMO feeling. And for some people, it's actually a feeling of FOMOA, which is a fear of missing out again, which is probably even worse than FOMO. But hopefully, if you use some of these strategies, you might still be able to nab some decently priced properties in this red hot market of ours. Just be aware that right now, the market is ever so slightly starting to slow down again, which might just be the slowdown that people have been waiting for so that they can get their foot in the literal front door. So thanks for watching another video covering the red hot property market in Australia. I think diversifying your income through things like the stock market and the Australian property market is a really good way to guard your investments against a downturn in one particular type of investment. So this is something that I'll try and cover regularly, especially if there's enough interest in it. Anyway guys, thanks for watching, and as always, I'll see you in the next video.